What do we mean by slippage? Slippage occurs when there is a mismatch between the expected price and the actual price at which a trade is executed. This happens because market prices are constantly changing due to supply and demand, and in a fast-moving or low liquid condition, price shifts can happen much faster than orders can be processed. In highly liquid markets with stable price movement, slippage is usually smaller because there are plenty of buyers and sellers to match orders smoothly. But in volatile or very illiquid markets, prices can jump between order placement and execution quite erratically, leading to a different full price than expected. This means that when you place an order, your trade might be executed at the next available price, which could be higher, lower, or the same price than you intended. Let's do a quick explanation of how this works. This is a chart of gold. Now imagine for a second you wanted to buy gold, but you are trading at the same time as some very important US economic data is about to be released. Now imagine you press the buy button just as the news comes out, and immediately within a few split seconds, price gaps higher as market volatility ramps up due to the news event. Now this awkward gap in the price is what we call slippage or a price gap. Now, because price jumped up or gapped higher within a few milliseconds after the news release, it means that your buy order that would have been filled down here will now be filled all the way up here. It'll be executed at the next available price, which isn't 3203, but 3216. Now, this is a very simple but very good example of why trading products with higher liquidity is often preferred by many traders, because it limits the amount of slippage that a trader might experience. However, it is impossible to avoid slippage regardless of what asset class you choose. So it's always a risk worth being aware of. Now, the other benefit of high liquidity is overall price stability. High liquidity means prices move more gradually and predictably, whereas illiquid markets will often see wild price swings. In other words, lower liquidity leads to more erratic price behavior or more volatility. Now, these two charts is a great way to visualize this. On the left, we have the euro-dollar currency pair, and on the right, we've got the euro-NOK currency pair. Now, both of these two charts is a 1-minute time frame chart. Both of them has the euro as a currency, and both of them is showing us the exact same time of day and trading session. But just look at how different both of these two charts are looking. The euro-dollar on the left saw gradual price moves throughout the session with smaller candles and far less volatility. The euro-NOK on the right-hand side, on the other hand, looks like a total mess with huge spikes, no clear direction, and just a huge amount of unwanted volatility in its price behavior. This chart is a really good example of why liquidity matters when choosing the symbols or assets you want to trade.